Hello and welcome back. If you're joining us for the first time, make sure to hit that subscribe button and ring the bell icon. This way, you'll stay updated with our weekly insights designed to help you navigate the world of finance. Are you ready to unlock the secrets to building lasting wealth? Dive into this must-watch video where we reveal the 7 key assets that will safeguard and multiply your fortune. Get ready to secure a financial legacy that will thrive for generations to come. Stay tuned till the end for 2 powerful bonuses, 7 game-changing takeaways, and 7 practical tips to unlock happiness and financial freedom. You can't afford to miss this. Banks often give us the misleading impression that our money grows through the simple accrual of interest. However, the reality is that the increased balance often fails to keep pace with inflation, leading to a gradual but significant erosion of wealth. As inflation continues to rise and bank interest rates lag, merely storing cash in bank accounts becomes less effective. In this video, we will explore 7 key assets that can help safeguard and increase your wealth, ensuring that your financial legacy can thrive and be passed down through generations. Asset 1. Precious metals. Gold, silver, and other precious metals have traditionally played a pivotal role in wealth preservation, acting as reliable safeguards against inflation and economic fluctuations. These assets are particularly valued for their ability to maintain purchasing power, even when traditional fiat currencies falter under economic stress. Their intrinsic worth stems from their scarcity and universal acceptance as forms of currency and stores of value, transcending geographic and political boundaries. For generations, families have invested in precious metals to secure their financial legacy, leveraging these assets' tendency to appreciate during periods of high inflation or market volatility. This characteristic makes them indispensable in a well-rounded investment portfolio, providing a counterbalance to more volatile assets. Moreover, precious metals can be passed down through generations with relative ease, maintaining their value over decades. By including these timeless assets in your wealth strategy, you not only protect your current financial standing, but also ensure that your prosperity can be shared with future generations, thereby fostering a lasting legacy of stability and security. As of now, without specific economic models or access to current market data and trends, it's difficult to provide a precise figure for 2025. However, if we consider the historical growth and recent increase in economic uncertainty, it wouldn't be surprising to see gold prices well above their current levels by 2025, potentially ranging between $2,000 to $2,500 per ounce or higher, depending on global economic conditions. For the most accurate and up-to-date information, it's advisable to consult financial forecasts and analyses close to your time of interest. By 2035, gold prices could be influenced by several factors, including global economic stability. If the global economy faces turmoil, recessions, or high inflation, gold prices are likely to increase as investors seek safe haven assets. Technological advancements, improvements in mining technology, or the discovery of new gold reserves could potentially reduce costs and affect prices. Monetary policies. Central banks around the world adjusting interest rates or engaging in quantitative easing could influence gold prices. Investing in gold, silver, and other precious metals can be an effective strategy for hedging against inflation and providing financial security during economic uncertainty. Here are some practical ways to invest in these valuable assets. 1. Physical metals, bullion coins or bars. You can purchase gold and silver coins or bars from reputable dealers. Coins like the American Eagle, Canadian Maple Leaf, and South African Krugerrand are popular among investors. Jewelry. While not the most cost-effective way due to markups for craftsmanship, investing in high-quality gold or silver jewelry can also be a way to hold physical metals. 2. Exchange-traded funds. Gold and silver ETFs. These funds hold physical gold and silver and are traded on stock exchanges. Examples include Spider Gold Shares, GLD for gold and iShares, Silver Trust, SLV for silver. These provide liquidity and ease of trading without the need to store physical metals. 3. Mining stocks. Companies. Invest in stocks of companies involved in the mining of gold and silver. These can offer leverage to the price of the metals themselves, often amplifying the gains and losses based on the underlying metal prices. Mutual funds and ETFs. Invest in mutual funds or ETFs that focus on mining companies, like the VanEck Vectors Gold Miners ETF, GDX. 4. Futures and options. Futures contracts. These are agreements to buy or sell gold at a future date at a predetermined price. They can be used for hedging and are traded on commodities exchanges. Options on futures. These give you the right, but not the obligation, to buy or sell futures contracts at specific prices before the options expire, providing a complex but high-leverage investment option. 5. Certificates. Gold certificates. Offer a way to own gold without physically holding it. These are issued by companies that possess gold, allowing investors to own the metal without the costs and hassles of storage. 6. Digital gold, gold-backed cryptocurrencies. Newer to the market, these digital tokens are backed by physical gold, stored in secure vaults, and can be traded on various cryptocurrency exchanges. Asset 2, stocks, mutual funds, and ETFs. Investing in a diversified portfolio of stocks from various sectors can offer substantial returns through dividends and price appreciation. Diversified holdings across various assets can reduce risk and enhance returns, managed by professional. Investing in a diversified portfolio of stocks, mutual funds, and ETFs presents a powerful strategy for wealth accumulation and protection, ensuring your financial legacy flourishes across generations. By allocating investments across various sectors, you significantly enhance the potential for substantial returns through dividends and capital appreciation. Stocks offer direct ownership in companies, providing the dual benefit of dividend income and the opportunity for substantial price appreciation as the company grows. Mutual funds and ETFs further fortify this approach by pooling resources to invest in a broad array of assets, thus spreading risk and tapping into a wider range of opportunities than might be feasible for an individual investor. This diversification is crucial in mitigating risks associated with market volatility and sector-specific downturns. Additionally, the professional management of these funds ensures that expert decisions guide the portfolio, adapting to economic shifts and capitalizing on emerging trends. Such a strategy not only aims to grow wealth in the short term, but also secures long-term financial health, making it possible to pass down a robust financial legacy to future generations. Through disciplined investing and the strategic allocation of assets, individuals can create a durable financial foundation that supports both current and future family members. Investing in stocks, mutual funds, and ETFs can be an excellent way to build a diversified portfolio that capitalizes on both dividends and capital appreciation. Here's a step-by-step guide to getting started. 1. Define your investment goals. Start by determining your financial goals, risk tolerance, and investment horizon. Are you investing for retirement, to buy a house, or perhaps for your children's education? Your goals will shape your investment strategy. 2. Open a brokerage account. Choose a reputable brokerage with reasonable fees and robust investment options. Many brokerages offer online platforms that make it easy to trade stocks, mutual funds, and ETFs. 3. Educate yourself on different asset classes: stocks, direct equity investments in individual companies, suitable for those willing to undertake research and accept higher volatility. Mutual funds, pooled investments managed by professionals that invest in a variety of assets. Great for those who prefer a hands-off approach. ETFs function like mutual funds but are traded on stock exchanges like individual stocks. They often have lower fees than mutual funds and provide instant diversification. 4. Diversify your portfolio. Invest across various sectors such as technology, healthcare, finance, and consumer goods to spread risk. Diversification can be achieved within asset classes, different stocks, or across asset classes: stocks, bonds, real estate ETFs. 5. Consider dollar cost averaging. Invest a fixed amount at regular intervals, for example, monthly, regardless of the share price. This strategy can reduce the impact of volatility by spreading the purchase price over time. 6. Monitor and rebalance. Regularly review your portfolio to ensure it aligns with your investment goals and risk tolerance. Rebalance as necessary by reallocating investments or adjusting your strategy based on performance and economic conditions. 7. Plan for taxes. Be aware of the tax implications of your investments, especially for dividends and capital gains. Consider consulting a tax advisor to optimize your tax liability. Asset 3. Bonds. Fixed income securities, such as bonds, are a cornerstone of a strategic investment approach aimed at wealth preservation and growth, providing a foundation for a secure financial legacy. These securities are particularly valued for their lower risk profile and the steady income stream they provide, making them an essential part of a balanced investment portfolio. By generating regular interest payments, fixed income securities offer investors a predictable source of income, which can be particularly valuable during times of market volatility or economic downturn. This reliability is crucial for those who are nearing retirement or need consistent cash flow to meet ongoing expenses. Additionally, the principal amount of these investments is typically returned at maturity, adding a layer of security for the capital invested. Including fixed income securities in your portfolio helps mitigate the higher risks associated with other investment types, such as stocks, ensuring that your overall portfolio remains more stable in fluctuating markets. This stability is instrumental in not just maintaining, but also methodically increasing your wealth over time, thereby securing your financial legacy for future generations. By carefully allocating a portion of your assets to fixed income securities, you can safeguard your investment while still pursuing growth through more aggressive investments, ensuring a well-rounded and resilient financial strategy that can support your family for generations to come. Investing in fixed income securities is a prudent way to achieve portfolio stability and secure a steady stream of income. Here are some common methods and examples of how to invest in these types of securities. 1. Government bonds, U.S. Treasury bonds. These are considered one of the safest investments since they are backed by the full faith and credit of the U.S. government. They come in various maturities, from a few years to 30 years. Municipal bonds, issued by states, cities, or counties. These bonds often offer tax-free interest income, making them attractive to investors in higher tax brackets. 2. Corporate bonds, investment-grade bonds. These are issued by corporations with higher credit ratings and are seen as safer than those issued by companies with lower credit ratings. High-yield bonds, also known as junk bonds. These offer higher interest rates due to the higher risk associated with companies that have lower credit quality. 3. Certificate of deposits, CDs. Offered by banks, CDs are time deposits with a fixed interest rate and maturity date. They are insured by the FDIC, making them very low risk. 4. Fixed income mutual funds or ETFs. Bond funds. These funds invest in a variety of bonds, allowing for diversification within the fixed income asset class. They can focus on government bonds, corporate bonds, municipal bonds, or a mixture of all. Income funds. These funds focus on securities that produce a regular income. They typically invest in a mix of bonds and dividend-paying stocks. 5. Savings bonds, U.S. savings bonds, such as Series E and Series 1 bonds. These are non-marketable securities issued by the U.S. government that are a popular gift to children as they are secure and grow over time. 6. Preferred stocks. Although they are technically stocks, preferreds have bond-like characteristics, including fixed dividends and higher claims on assets than common stocks. Asset 4. Insurance policies. Life and other insurance policies play a pivotal role in wealth protection and ensuring financial stability for heirs, especially in the face of unforeseen circumstances. These insurance products serve as a foundational element of a sound financial plan, safeguarding your family's economic future and your hard-earned legacy. Life insurance, for instance, provides beneficiaries with a tax-free lump sum upon the policyholder's death, offering immediate financial relief and stability during difficult times. This payout can be used to settle debts, cover living expenses, or maintain the family's standard of living, thereby preventing the rapid erosion of wealth that can occur when primary income sources are disrupted. Similarly, other types of insurance, such as disability or long-term care insurance, protect against potential income loss due to serious illness or disability, ensuring that savings are preserved for future generations rather than being depleted by unforeseen health issues. Moreover, sophisticated estate planning can incorporate these insurance policies to facilitate the smooth transfer of assets, reduce estate taxes, and manage other liabilities that might otherwise burden the next generation. By using insurance strategically, individuals can not only protect, but also potentially increase their wealth through efficient tax planning and asset management techniques. Investing in life and other insurance policies can provide crucial financial protection and stability for your family and heirs. Here are several types of insurance policies and how they can be used effectively in wealth protection and estate planning. 1. Life insurance. Term life insurance provides coverage for a specific period, such as 10, 20, or 30 years. It's ideal for meeting temporary needs, like covering a mortgage or funding college education for children. Whole life insurance offers coverage that lasts a lifetime and includes a cash value component that grows over time. This can be used as part of estate planning to provide a legacy for heirs or to cover estate taxes. Universal life insurance, similar to whole life, but with more flexibility in premium payments and the death benefit. The cash value grows based on a fixed interest rate or a market-based rate. 2. Disability insurance. Short-term disability covers a portion of your income for a short period, typically a few months to a year, if you are temporarily unable to work due to illness or injury. Long-term disability provide a percentage of your income if you are disabled for a longer period of time, usually until retirement age. This is critical to protecting your earning capacity and ensuring financial stability. 3. Long-term care insurance covers the costs of long-term care services, either in-home or at a care facility, which are not typically covered by health insurance or Medicare. This can protect your savings and assets from being depleted by high long-term care costs. 4. Critical illness insurance provides a lump sum payment if diagnosed with a specified critical illness such as cancer, heart attack, or stroke. This can be used to cover unexpected medical costs or compensate for loss of income during recovery. 5. Annuities, immediate annuities. You pay a lump sum in exchange for regular payments that start immediately and continue for life. This can provide a steady income stream for retirees. Deferred annuities. Payments are delayed until a future date. These can be used to grow investments on a tax-deferred basis and then provide income during retirement. Asset 5. Safe haven currencies. In times of economic uncertainty, stable and widely trusted currencies like the US dollar, Swiss franc, and Japanese yen become crucial safe havens for investors looking to protect and grow their wealth. These currencies are supported by strong, stable economies and are perceived globally as resilient in the face of financial turmoil. The US dollar, often considered the world's primary reserve currency, offers reliability due to the vast size and strength of the American economy. The Swiss franc benefits from Switzerland's political neutrality and its financial system's reputation for stability and security. Similarly, the Japanese yen is backed by Japan's significant global economic presence and its monetary policies that often support currency strength during global crises. Investing in these currencies can serve as a strategic defense mechanism against portfolio volatility and currency devaluation, providing a buffer that helps maintain the value of an investor's assets. Additionally, by incorporating these currencies into one's financial strategy, an investor not only protects their immediate financial interests, but also sets a foundation for enduring wealth that can support future generations. This approach ensures that personal financial legacies are not only preserved, but also have the potential to thrive and expand, even in challenging economic climate. Investing in stable and widely trusted currencies such as the US dollar, Swiss franc, and Japanese yen can be a prudent strategy to preserve and potentially increase your wealth during times of economic uncertainty. Here are some practical ways to invest in these safe haven currencies. 1. Foreign currency accounts. Open a foreign currency. Savings or deposit account in one of these currencies at a bank that offers multi-currency accounts. This allows you to hold and manage money in a stable currency without needing to convert it back to your local currency immediately. 2. Currency exchange traded funds. ETFs. Invest in ETFs that track the performance of the currency. For example, US dollar ETFs such as the PowerShares DB US Dollar Index Bullish Fund, UUP, which tracks the dollar against a basket of 6 world currencies. Swiss franc ETFs such as the Currency Shares Swiss Franc Trust, FSF. Japanese yen ETFs such as the Currency Shares Japanese Yen Trust, FXY. 3. Forex trading. Engage in forex trading by buying and holding these currencies against weaker currencies or those expected to decline due to local economic issues. This is more speculative and requires a good understanding of forex markets. 4. Currency futures. Invest in futures contracts for the US dollar, Swiss franc, or Japanese yen. This method can be used for hedging against currency risk or speculating based on your expectations of currency movements. 5. Money market funds. Invest in money market funds denominated in these currencies. Such funds invest in short-term debt instruments and are a safer way to gain exposure to foreign currencies. 6. Bonds and debt instruments. Purchase government or corporate bonds issued in these currencies. For instance, U.S. Treasury bills, T-bills, are denominated in U.S. dollars and offer a secure investment. Asset 6, art and collectibles. Investing in collectibles such as vintage cars, rare art pieces, handcrafted luxury handbags, limited edition watches, and first editions of iconic books offers a unique opportunity to not only diversify an investment portfolio, but also to safeguard and potentially increase your wealth. These tangible assets often appreciate in value over time, especially as they become rarer and demand increases among collectors. For instance, vintage cars can become coveted for their historical significance and aesthetic appeal. Rare art pieces can gain value as the reputation of the artist grows or as art historical importance is reassessed. Investing in collectibles like vintage cars, rare art pieces, handcrafted luxury handbags, limited edition watches, and first editions of iconic books can be a fascinating and potentially lucrative way to diversify an investment portfolio. However, it requires a blend of passion, knowledge, and strategy to be successful. Here are some examples and tips on how to invest in these niche markets. 1. Vintage cars. Research. Understand which models and years are most valuable and why. Collector car auctions and historical price data can provide insights. Storage and maintenance. Proper storage and regular maintenance are crucial to preserving the car's value. Purchase channels. Buy through reputable dealers or at well-known auctions to ensure authenticity. 2. Rare art pieces. Education. Learn about different art styles, periods, and artists. Knowledge is key in identifying potentially undervalued pieces. Provenance and authentication. Always verify the authenticity and legal ownership of the artwork. Insurance. Ensure your investments as art can be highly valuable and susceptible to damage. 3. Handcrafted luxury handbags. Focus on iconic brands. Invest in brands known for their value retention, such as Hermès and Chanel. Condition and rarity. The condition of the bag and its rarity will significantly impact its value. Secondary markets. Luxury resale platforms can be good places to find deals and understand market prices. 4. Limited edition watches. Research limited runs. Watches that are produced in limited quantities typically retain or increase in value. Keep original packaging. Original packaging and documentation can enhance the value of collectible watches. Maintenance. Regular professional servicing is essential to maintain functionality and value. 5. First editions of iconic books. Condition. The value of first editions greatly depends on their condition. Mint or near-mint conditions are most desirable. Rarity and demand. Books that were limited in production or are highly sought after by collectors are typically the most valuable. Authenticity. Make sure the book is a genuine first edition by doing a literature search. Asset 7. Real estate. Owning property is a time-honored strategy for building and securing wealth, offering a dual advantage of capital appreciation and rental income. Real estate investment stands as one of the most effective ways to generate passive income while simultaneously increasing the asset's value over time. This enduring asset class typically appreciates in value, responding positively to improvements, developments in the area, and general economic growth. Rental properties provide a continuous source of income that can cover mortgage payments and operational costs, with the potential to yield surplus revenue. By strategically selecting properties, managing them effectively, and planning for long-term ownership, you can establish a robust financial foundation that supports your current lifestyle while also securing your family's financial future. This approach ensures that your wealth is not only preserved, but also has the potential to grow, providing a lasting legacy to be passed down through generations. Investing in real estate is a proven method to build wealth over time through capital appreciation and rental income. Here are several practical ways to invest in real estate, each offering different levels of involvement, risk, and potential return. 1. Residential properties. Buy and hold. Purchase residential properties such as single-family homes, apartments, or multifamily units and rent them out. This strategy provides monthly rental income, while the property ideally appreciates in value over time. Vacation rentals. Invest in properties in popular vacation destinations and rent them out short-term on platforms like Airbnb or VRBO. 2. Commercial real estate. Office buildings. Acquire office spaces in business districts with high demand. Long-term leases to businesses can provide stable rental income. Retail spaces. Invest in retail properties such as shopping centers or standalone stores. Retail leases often include a percentage of the retailer's sales, increasing potential income. 3. Industrial real estate. Warehouses and logistics centers. As e-commerce grows, so does the demand for storage and distribution centers. These properties can be rented to companies for use as warehouses or distribution centers. 4. Real estate investment trusts, REITs. For those who prefer not to directly manage properties, REITs offer a way to invest in real estate through the stock market. REITs own and operate income-producing real estate and are required to distribute at least 90% of their taxable income to shareholders annually. 5. Land development. Buy land. Purchase undeveloped land in the path of growth and hold it for resale as the area develops. Or develop the land yourself by building residential or commercial buildings. 6. Real estate crowdfunding. Participate in real estate investments through crowdfunding platforms, which allow you to invest smaller amounts of money in larger projects, like commercial developments or large residential complexes. Here are the 7 key takeaways. Why you should not keep your cash in the bank. 7 hidden assets that will explode your wealth. Precious metals. Gold, silver, and other precious metals are emphasized as crucial for wealth preservation, acting as hedges against inflation and economic uncertainty. Their intrinsic value and universal acceptance make them vital for a balanced investment portfolio and generational wealth transfer. Stocks, mutual funds, and ETFs. These are highlighted as essential for achieving substantial returns through dividends and capital appreciation. A diversified portfolio across various sectors can reduce risks and enhance returns, providing a solid foundation for wealth accumulation and legacy building. Bonds. Fixed income securities like bonds provide lower risk and a steady income, essential for balancing an investment portfolio. They contribute to portfolio stability and ensure a continuous income stream, which is crucial for long-term financial planning. Insurance policies. Life and other insurance policies are vital for protecting wealth and ensuring financial stability for heirs in unforeseen circumstances. They play a critical role in estate planning and securing financial future for generations. Safe haven currencies. Investing in stable and widely trusted currencies such as the US dollar, Swiss franc, and Japanese yen is recommended during times of economic uncertainty to preserve and potentially increase wealth. Art and collectibles. This niche investment in items like vintage cars, rare art pieces, and limited edition watches can diversify an investment portfolio and be both culturally enriching and financially rewarding. Real estate. Owning property is portrayed as a classic strategy to build wealth through capital appreciation and rental income, offering various levels of involvement and potential return, from residential to commercial and industrial properties. Bonus: 7 practical tips and examples on why you should not keep your cash in the bank. 7 hidden assets that will explode your wealth. Precious metals. Tip: Use precious metals like gold and silver as a hedge against inflation and economic uncertainty. Example, allocate a small portion of your investment portfolio, for example, 5–10%, to precious metals. Consider buying physical gold or silver bars, or investing in a precious metals ETF for easier liquidity. Stocks, mutual funds, and ETFs. Tip: diversify your investments across various asset classes and sectors to spread risk and enhance potential returns. Example: create a balanced portfolio with a mix of stocks, mutual funds, and ETFs. Regularly contribute to a broad market index fund and a few sector-specific funds like technology or healthcare. Bonds. Tip: incorporate bonds into your portfolio to provide stability and steady income. Example: purchase a mix of government and corporate bonds, or invest in a bond mutual fund or ETF to receive regular interest payments while maintaining easy liquidity. Insurance policies. Tip: protect your financial stability and provide for your heirs in case of unforeseen circumstances. Example: invest in term life and disability insurance to ensure your family's financial needs are covered in your absence. Consider a whole life insurance policy as part of your estate planning. Safe haven currencies. Tip: keep a portion of your assets in stable and widely trusted currencies to preserve capital during market volatility. Example: open foreign currency accounts or invest in currency ETFs for currencies like the US dollar, Swiss franc, and Japanese yen. Art and collectibles. Tip: add unique value to your portfolio by investing in items that potentially appreciate over time. Example: collect rare art pieces from emerging artists or invest in vintage cars and luxury watches, ensuring proper authentication and maintenance to preserve their value. Real estate. Tip: use real estate investments for both capital appreciation and generating rental income. Example: purchase rental properties in high-demand areas or consider real estate investment trusts, REITs, if you prefer not to manage properties directly. Thank you for watching. If you haven't already, please consider subscribing to our channel. Your support enables us to continue delivering valuable content like this every week. Let's grow our financial knowledge together. Important disclaimer: Financial Independence Now is not a licensed financial advisor or brokerage entity. Our videos are designed to educate and inspire, offering general information to help you on your journey. They should not be taken as personalized financial advice.